Welcome to another financial self-defense class. So today we're talking about how the tax systems work in both Canada and the U.S. and a simple way that taxes can be lowered. Really common question, families and individuals all the time. How can I pay lower taxes? So we have to learn about the systems themselves. The systems are very similar in both countries. They both use a progressive system, which means that the rate that taxes are calculated at is always the higher income you earn, the more you will be taxed. Remember, this is personal income, not dividends or business income. As a comparison, though, Canada has us file one set of taxes for both federal and provincial, so one set of paperwork, and in the US, people must file separate federal and state tax paperwork. Now to see how that really works. This is for both countries. Each government decides a tax rate for the different tax brackets. So you can see the more money you make, the higher the taxes that you will be paying on that money. One key thing to note is that in both countries, there's a certain amount that you can earn that is not taxed at all. Remember, this is income from your job that is taken right off your paycheck and sent in to the tax authorities in each country. So a person who earns $120,000 in a year would initially be in the tax bracket where they would pay a maximum of 26% taxes on that income. Another key point to remember, this is only the federal taxes. Each province and state also has their own tax brackets that need to be included in our calculation. On to how the provinces and states have their brackets set up, it's exactly the same. Taxable income from the job and a tax rate assigned to each bracket. And again, there is an amount that is free. No taxes are owed on that money under that level. Due to the fact that the brackets don't line up exactly the same, and they won't be the same between province or state as well, we will end up with more tax brackets. And when we put them together, we will notice that they fall into a bracket that has a tax rate of 38.5%. This will be their marginal tax rate, or MTR. So in order to calculate what taxes are owing, we take the 120,000 and subtract the amount at the bottom of the range it is in. That gives us 5,250. Then we multiply it by that 38.5%, gives us about $2,021. Then we just continue these calculations on down with every bracket, giving us a total of 26,641. Now we get to the fun part. By saving our money in special accounts called RRSPs in Canada and 401ks in the US. These two account types lower your taxes immediately, but are tax deferred. So that means you will have to pay taxes later when you withdraw the money. Don't let that turn you off though, because by using these and other accounts strategically, we can lower your taxes in retirement as well. Can't cram everything into one video. So in this example, the person saves, say, $10,000 in an account labeled an RRSP. It will lower their net income possibly down to the next lower tax bracket. Both governments set maximums on how much you can save in one of these accounts. In Canada, it's 18% of the previous year's income. And even more significant is the fact that you can carry forward the amounts into future years where you might be earning a higher income. In this example, they're low enough that they can get into a lower marginal tax rate. Unfortunately, in the 401k plans, there is no option to carry forward the deductions into any other year. You must save your money and get the deductions in the year you earn it. Back to common ground. Both countries, when we recalculate using the 110,000 taxable income, redo all the calculations, their new taxes owing is $23,242. Best part, this is just part of a great financial plan. So subscribe so you can learn more techniques to get yourself not only saving on your taxes now, but also remember they've saved $10,000 towards their retirement just by putting it into that account type. And all growth inside is tax deferred until withdrawal. To recap, both the US and Canadian tax systems are designed to encourage you to save money now, plus lower your tax bill each year you do. Just a few more important definitions. Gross income has specific things it includes, like wages, interest, and business income. We've talked today about tax deductions that are subtracted from your gross income to reduce to your net income. Reduce your tax amounts dollar for dollar. One Canadian tax credit I always mention is the federal disability tax credit. Deductions, credits, and brackets can change each year, so the experts there are the accountants. My last really important information, Remember, we've only talked about the account type today. This is a label used for taxation purposes. The investment types can be anything from GICs, bonds, mutual funds, stocks, and more, which I'll be discussing in future videos. This video only covered a small part of how account types can be used to lower income tax. I've thrown a lot of information at you today in a very short time. I do hope you enjoyed and learned something. There is way more information on my free Financial Self-Defense Education Dojo, hosted on Google platform with custom templates, worksheets, step-by-step instruction guides. You'll also find the information about my most popular and most requested exclusive to women financial self-defense course. So here's all the details, and I'd love to see you drop by the school. Everything's free. Have a great day. Don't forget to subscribe.